What is up, everybody? Welcome back to the Dentist Who Invest podcast, where I am sat opposite familiar face on the Dentist Who Invest podcast, Harry Singh from way back in the flipping day, episode number 1, I believe. Harry, our catch up has been long overdue. How are you, my friend?
Yeah, no, really good. Thanks for inviting me back again. As we said, it seems like it was yesterday when we recorded that podcast in the back of your bedroom. Obviously, I wasn't there with you, but looks like you upgraded your office now. It looks middle of Canary Wharf.
Yeah, it's cool, isn't it? It's my flat, but this is the not the private quarters. This is the kitchen
Yeah.
this time. But I'm actually moving back to Ireland in a few weeks, so I'm gonna have to say my farewells to this place rather shortly, unfortunately. How have you been?
Okay.
What's new in your life since we last spoke?
Yeah, no, really good. Time flies. So, as you know, I've got Dental Property Club, BTC Botulinum Toxin Club, and our aesthetics clinic. So, yeah, what we did was we changed location, got a new high street location in Stevenage, Hertfordshire. Really big premises, but we also do our training here as well. So, no hotel venues, etc. And it's really good having a dedicated office. One, the wife's happy because I'm out away from the house. But yeah, I'll see more production being done, more productive because got a dedicated office, going here, it's work mode straight away. And also, like you, I'm quite sociable, like to banter with the team, to see them every day. And compared to at home, I found it quite hard to work from home, too many distractions, but also kept on eating, putting too much weight on with all the biscuits and cakes there. So when my kids were younger, I could blame the kids because they were only 4 and 5, they couldn't speak, but now they can answer back and no, daddy nicked all the food, not them. So it's good there. So yourself, been busy?
Yeah, always busy, my friend. Yeah, things are really going places. I'm really excited to see what the future holds. There's a lot of stuff coming my way, and I feel like one of the biggest skills or one of the biggest tasks that you have is managing it all, and also getting good at delegating as well, which I used to be not so good at whatsoever. I used to try to do everything, but the fact is you only have 168 hours in the day, and if you're spending a few hours doing the unnecessary stuff, whereas you've got the things that you can delegate versus the things that you have to do yourself. That's actually a skill in itself, and I'm getting better at it. Super cool that I saw you were hanging around with none other than Richard Branson not terribly long ago. I feel like that's a flipping Dentist Who Invest podcast waiting to happen. Can you can you pull some strings there, Harry?
Yeah, maybe. You never know. I tried to get him to have some Botox. He wasn't too keen there. So yeah, no, it was a really good experience last December. The biggest hurdle was getting my wife's permission because obviously it's freezing in winter in December, and I'm going to the Caribbean and the British Virgin Islands in Bermuda shorts and Hawaiian shirts. I think I had to borrow a couple of your Hawaiian shirts, didn't I?
Oh, I've got a few spare. I've got a few spare.
Yeah, there. So, but no, it's really good. Like you, I'm a big believer in networking. So the circles I was hanging around with, they had this private week organized in Neck Island, and they needed 50 people. So they got me involved. But the hardest part, you're not going to feel sorry for me, is getting there. So you go from London to Antigua. I spent a couple of extra days in Antigua just to get customized. Didn't tell the wife it was extra. From Antigua to you go to Beef Island, and it's like one of those small planes. There's only 12 seats. I'm quite good at flying, but like I was shitting my load on this. It's like every cloud I went through is like turbulence, like times 10. And the pilot was quite funny. He was on his mobile phone all the time, so like he didn't really care. And once you get to Beef Island, you take a boat to Necker Island, and this boat's going up and down, up 20 feet in the air. I was sick about 3 times. Then once you finally get to Necker Island, oh my God, it's like paradise. And it's a bit like life, business, investing. You're going to get ups and downs. It's not going to be a smooth ride all the way through. But once you reach your end destination, your final goal, it's all worth that sacrifice, that effort.
I love that metaphor. That is so cool. What's Richard like in the flesh?
He was meeting us for breakfast every morning. He's really interested. And like we've said, it's always be interested in the person, be more interested on them. And he's really interested in what everyone was doing, etc. But no, really, but he trains 3 hours every day. So he has 1 hour
Dude, he's
private.
huge. He's actually huge. Like his arms, he's massive.
Yeah,
Like
yeah,
when I
yeah,
saw him in that, you were in the back of the golf caddy, and he
yeah,
was like, you could just see his back, and you'd like a little selfie, right? And I was like,
yeah,
dude, does Richard Branson work out? Because he's a
yeah.
big guy. He's a big guy.
Yeah, yeah, he plays 2 hours of tennis. So what he does, he plays 1 hour of tennis on one court. Then the other court is about, I don't know, 3/4 of a mile away from the other part of the island. So the tennis coach gets a buggy to go there. He swims to the other part of the court. Then he has another lesson. Then he has 1 hour in the gym. But no, yeah, he is super fit. And then, as we always say, this, yeah, you could be the richest person on earth, but if you're not going to survive or live that long because you've got unhealthy habits, but he's that token that where, yeah, health and business has to go together.
You'll often find that about very, well, not even necessarily very wealthy CEOs, but definitely CEOs, you know, that they actually take time out of their day to prioritize their health. And the thing about it is, I used to be a real stickler just for sitting on the laptop 15 hours a day, right? And doing that and not doing anything else. And
Yeah.
actually for me, because I really enjoy that, it's harder for me to not do that than do that, right? Which is not, I appreciate it's not everybody's idea of fun. Are you with me? Yeah. So what I had to do was I had to actually say to myself, no, James, out of your priorities, you actually need to prioritize your health even more, even though you find it, even though for most people that's easy and that's hard for you, that's where you need to go. Okay.
Yeah.
And the way someone explained it to me once was, okay, well, actually there's two little anecdotes I'm going to quickly share on this one, right? The first one was, you can make as much money as you like, but when you reach that end point where you've hit your, whatever it is, your retirement figure is, if you have no health to actually enjoy it, then what the hell was the point in the first place?
True.
Yeah. And then the second thing somebody said to me was, this was from my PT, and he said, James, you're a dentist. How important is it to you to brush your teeth? When you hear about someone not brushing their teeth, right?
Yeah.
How crazy do you think that is? And I thought it's pretty crazy because I've seen that so many times.
Yeah.
And then he was like, you know, whenever you don't exercise, it's like you not brushing your teeth except for your body.
Yeah.
And you know what? That always stuck with me, because now I was like, it's insane, you know, to get out of your bed and not brush your teeth. You know, it just saves you so many problems further down the line. And it's exactly the same. That when he put it like that, I totally grasped it. I grasped it before, but I grasped it on a whole other level.
Yeah. And I was like you, I'm a workaholic. And because you love your work so much, you don't take any breaks.
This is fun. Like, seriously, you know, this is, because it's fun, it's harder to not do this than do this, you know, for me personally. And I always feel as well, you know, again, we'll pull this conversation back to where it's supposed to be, which is on the topic of houses very shortly. But yeah, pathway of the entrepreneur, you know, I actually feel like it has to be, whatever the thing is that you choose, that you want to put your energy into, it actually has to be fun as a prerequisite versus doing something you don't enjoy. Because the thing about it is, you can only actually put 18, 19, 20 hours a day into something, which is 100% necessary, by the way, if you enjoy it. Because if you have to spend energy on those 18, 19 hours a day, then you have to recharge at some point, and there's not enough hours in a day to recharge. Whereas if whatever you do gives you energy because you enjoy it and you find it fun, then guess what? You get more energy out to put back in. And it's like a positive feedback cycle.
No, perfect. Yeah, definitely. Yeah.
100%, man. Anyway, Harry, speaking about your passion, property is what we're here to talk about today. The property market at the minute is looking a bit bubbly. Just like flipping every market, you know. I mean, I get it that there's been a bit of a correction recently, you know, but things were pretty overvalued. What are your thoughts? I mean, I bet you get this question a flipping million times a day. Good time to buy, bad time to buy.
Yeah, dentists go, when can I buy? When can I buy? When's the best time to buy? I go, well, if I knew exactly from the date and hour, I'll be a billionaire. So if anyone says exactly what they know is going to happen in the future, run a mile from them there. So, but obviously we can talk about what's happening in the past during lockdown. Everyone thought because there was a non-economic recession that price will go down. And there was a combination of factors of the Chancellor getting rid of stamp duty, holiday. A lot of people in my area that were moving from London to Hertfordshire because they didn't have a garden, they were stuck at home, they wanted to have a garden, so moved to more rural areas where our prices went up. So it's a combination of factors where it was just a fake bubble where people paying 10, 20. So they were saving 5% on stamp duty, but paying 10, 15% more than the market value there. So it wasn't a good time to buy, very good time to sell. So if you had any properties to offload, that was the perfect time. But what we did find, the rents stabilized as well. So I thought the rents would be going down, but actually our rents did stabilize because there were going to be some people that could never afford to buy anyway. So the rent stabilized, and actually because we had good quality, because I always talk about, people talk about their long-term plan. I'll buy a property, appreciate value in 10, 15 years time. That can only happen if you've got good tenants. So we are very strict with our tenants, and even during lockdown where some of them lost their jobs, I'm very proud to say with over 30 properties, we didn't have any defaulting rents from a single. I actually offered to say, oh, if you're struggling, you can delay your rent for 3 months. No one took it up. Every single tenant paid on time there. And that's what a lot of property investors forget. It's the quality of tenant that's going to give you that financial freedom over the long term.
Do you know what would be super cool? Obviously, that's something that's planned out pretty well for you, given what you've just said. What is your pro forma? What is your method of selection for those tenants? Or if there's like a really precise, detailed would take like 20 hours to explain process, even if you can just explain the main points or the main parts, I think that would be so valuable.
Yeah. So what I do is, let's say I'm investing in a new area, I would go and visit every single letting agent and pretend to be a tenant. So say I'm looking to rent a property. Then I see what process they have. Are they polite? Are they courteous? Do they show me the properties I want straight away? And then I never, ever agree to obviously rent a property. Then I want to see what their follow-up is like. If they don't follow up, I'm not going to use them myself. If they're phoning me every 2 other days, go, are you interested? If you're not interested in that one, we've got this one, which are very proactive, then I'm going to pick that letting agent. So put yourself in the shoes of a tenant. Do they market the property well? Do they show you? Are they good at timekeeping? And do they follow up? Are they really proactive? Because if I'm going to put a property with them, I want them to go guns blazing to get me a tenant as quick as possible. So once I've chosen my letting agent, the second thing I do is we go 15, 20 pounds below the market rent, because I'd rather have 50 tenants to choose from than only 5. So let's say rent's £900 a month, we'll put it on for 875. We will get 50 to 60 tenants, and then we'll pick the cream of the cream, pick the best ones. So proactive letting agent, and you can be greedy and choose from 1 out of 50 tenants.
That's so cool and so interesting. And even though property is not really my bag, a little bit about it, from secondhand information, I actually think that applies to business as well. I would rather spend, there seems to be a race to the bottom in terms of wages and things like that. And if you're paying somebody £14 an hour versus £13 an hour or whatever, the £13 an hour is like a badge of honor. But I'm like, I'd rather pay someone £14 an hour who's going to put twice the effort in and generate me twice the profits. You know what I mean? And it's totally like that. It's a false economy. I love that. That's really cool.
Yeah. We weren't expecting to talk about that, but it's all good.
That's cool, man. I love that. No, stuff like this is what makes the content valuable. And, people who are into property, they'll be all ears for stuff like that. So from our last podcast, I remember you talking that broadly there are 2 reasons that you'd invest in property. One is capital appreciation and the other is rental yield.
Yeah. Very good.
Given what you've just said about the market, how does that affect investors who are interested in investing based on either of those 2 metrics? As in, let's say at the moment, because things are bubbly, maybe you want to gear your investments more towards rental yield, or maybe you want to do less rental yield. I'm not sure, and I'm curious how the current market situation affects what we've just said.
Yeah, so we are expecting, never guaranteed, obviously a dip in the prices, a correction in the property market. So obviously going back, if you're investor, capital appreciation or cash flow, but let's go back because there's 2 types of people that get into property, investors or developers or sellers. So with the price correction, it's not going to be a good time to be a developer or be selling properties, because you're going against the market, plus the cost of materials are so high, it's going to erode all your profits. So you're going to be holding for the long term. So that's the first thing. Then capital appreciation is never guaranteed. I always go for cash flow, but that is going to be so important in the next 2 to 3 years. You want to be going for high yielding cash flow properties more compared to capital appreciation, because we're not going to get much capital appreciation. And what we found in the last recession or the last recession, when prices go down, rents go up. So, for example, in Stevenage 2008, I think you were still in school then, weren't you, James? 2008?
Probably. That's hilarious, actually. I think I just finished high school. How crazy is that?
Yeah. So 2008, average 3-bedroom house in Stevenage, I was getting rental £750. 2009, 1 year after the recession, still during the recession, we were getting £1,200 rent for that same property, 750 to 1200, because people were scared to buy. They want to offload their properties as quick as possible because they thought the recession was going to last forever. So more people end up renting because there's not enough properties. You can increase your rents. So it'll be a really good time for those long-term investors for cash flow to really get good yields. And actually, I saw an article this morning where rents are going up by 10% in the last 6 months.
Wow. Okay. Food for thought on that one. Do you hold most of your properties in your personal name or through your limited company?
Good question. So obviously, when I started investing in 2002, we could claim the mortgage interest. So most of mine are in my personal name, actually with my wife, because you get the capital gains allowance. So if I did sell any properties, I get 2 lots of capital gains tax allowance there. I know so many dentists come up to me and say, oh, I want to hide the properties for my wife. I'm just going to buy under my name. I go, you can't hide anything, so they'll still find out there. So it makes no difference it's better to buy under both names there. So going forward depends on your tax situation. This is the second most common question we get asked, because dentists hate paying too much tax there. So if you don't need the money, obviously, let's give a caveat first. Obviously, I'm not qualified to give you accountancy advice, seek professional advice. So generally speaking, if you don't need the money from the property portfolio, then limited company is normally better because you can claim the tax relief of your mortgage interest. Mm-hmm. If you do need the cash flow, i.e. reducing your commitment to density, and you do need the cash, personal name may be better. Or if you are a developer selling property, personal name would be better because you get the capital gains tax allowance of, let's say it's 11 grand per year, and you buy with your wife, the first 22 grand is tax free, which you don't get with a limited company. The other question we get asked is, I bought under my personal name. Is it worthwhile me transferring to a limited company? You are going to have capital gains tax and stamp duty to pay. So for most people, it's not worthwhile transfer, especially if there's been a lot of capital growth in your portfolio. It's not worthwhile transferring. But obviously, each situation is different. Seek accountancy advice on what is best for you.
And then, I mean, off the top of my head, so the 12,300, the capital gains allowance, and then shared between you and your wife, obviously multiply that by 2. Capital gains maxes out at 20% anyway, right? Yeah. Corporation tax is going to max out at like flipping 25% in the not too distant future. You know what I mean? You know, but of course, on the flip side, well, what I'm going to guess most people say is it's easier to accrue more money in a limited company. You know what I mean? Yeah. Because obviously the tax implications of actually having the money there in the first place might mean that it's easier to keep it in there and then buy a property. It depends where the money is as well.
Yeah. So you can buy, and also the buy-to-let mortgages are much more friendly to limited companies, which they never were at the beginning. So with capital gains, with property, you've got 19% and 29% depending on your tax bracket. But yeah, there's pros and cons with each one. There's no, unfortunately, one answer that is straightforward. There's one answer that is going to be applicable for everyone. Obviously, seek your advice.
What was that thing on the 29% just then?
Yeah, I'm sure from memory, because obviously I haven't sold much. I'm sure it's 19 and 29% capital gains tax, depending. So if
is that specifically for properties? Because,
yeah, for property, yeah.
Right then. Okay, yeah. Okay, so it's slightly different than what I said, which is something interesting that I didn't know actually. Because when it's assets in your personal name, like stocks, paper assets, and things like that, it's 10 and 20.
18 and 28%. Yeah. So
that changes things.
Yeah. So because obviously, with assets and businesses, it's a fixed rate. But with property, the government obviously always gets you. So yeah, if you're a lower tax bracket, 18%, higher tax bracket, 28%. But then if you bought under your personal name or joint names with your wife, you get the first, say, 24 grand tax free.
Yeah, that's interesting. That is very interesting. What about SPVs specifically? Would you recommend using those?
Yes and no. We do use them when we're doing developments and individual projects because then it limits the liability to that particular project. Obviously, you got to weigh in obviously the extra admin charges, setting up the company, accountancy fees, and obviously having that in the public domain. There. So for my long-term properties buy to let, no, I'll keep it simple. But for individual, especially if we're using external investors and outsourcing funds, then we will have a separate SPV per project.
Interesting. Okay, so maybe not something you'd recommend for the beginner.
Yeah, because obviously, yeah. And then also what we've noticed is mortgage lenders don't like you being directors of too many limited companies. So obviously they'll do a search for you and see like you've got 20 SPVs and 20 other limited companies and go, God, there's a lot of liability on this guy. Let's not lend to him.
which makes sense in a way, because obviously someone who's done that is attempting to spread their risk as much as they can, and it suggests that they're less bothered about every single individual one rather than the one that they do have that has their whole portfolio in there, or their baby.
Yeah, and the trick is not to, one of my mentors said, you don't have to be a director of every single limited company you own. As long as you're a majority shareholder, you're fine. You've got the same rights. Everyone thinks by being a director, they're going to be top dog, but sometimes it actually works against you being director of too many limited companies.
Interesting. Food for thought on that one. That's super cool. Where do you think interest rates are going to go next? I know you said you didn't have a crystal ball earlier.
Yeah, God, the way they made announcements this week on inflation, they have to go up. Well, not have to, but it would make sense. But you never know, because obviously everything's political, but obviously choosing a new prime minister, they may not want to. I know it's independent, they say, with the Bank of England, but there's obviously some kind of pressure always put by government. But the average for the UK in the last, say, 50, 60 years has been around 5.5%. So we've had a generation of people that are used to thinking this low interest rate is normal. So I'm expecting it to go up. And for my strategy and what we teach to our students, we want it to go up because then we can get these bargain properties where we're not taking advantage of people, we're saving people getting repossessed and bad credit history, but we are looking for those motivated sellers and bargain properties. So yeah, short answer is yeah, I expect it to go up. I think it will be slow, 0.25, 0.5% increases. And I expect by the end of 2023 to be up by another 2.5%.
You know what? I asked that question, but I was totally conscious that it was a massive curveball. So, but thank you for that answer. But here's the thing, you know, on interest rates, it actually gets really, really, really deep into financial theory. And we're in a bit of a weird moment at the minute, okay? Because there's only really two ways there's two main ways a central bank can stimulate the economy, right? Interest rates and printing more cash, okay? Put the interest rates down, everybody wants to lend, there's more credit floating around, and then the economy gets a bit of a boost, right? Because more people are buying things and assets and what have you. And everybody looks richer as well, okay? Because some of that credit makes its way into the stock market and property, okay? Yeah. So generally speaking, as time goes on, they boost the interest rates when they need to cool off inflation. Then they they decrease the interest rates when they need to stimulate the economy. But the overall trend has been this tangent that's downwards and downwards and downwards and close to zero, okay? So when it does get to zero and they're basically all out of options if they need to boost the economy, the only other thing that they can do is print cash, okay? Yeah. The thing about it is if you begin to put the interest rates up too much again, you stifle the economy. So there's only really one area that's an area of give, and that's to print more cash. But that also drives property prices. But here's the thing: no one really knows. That's the theory, and it actually gets a little deeper than that still, okay? Because it's related to the government's debt, and there are other methods that you can decrease debt, and then therefore have a little bit of scope to put interest rates up. So basically, long story short, who the heck knows?
Yeah, no one. Yeah, and yeah. If just before the lockdown or during COVID, everyone's betting on property crash and property prices went up by 30%. So who knows?
Exactly. Interesting one. Cool. Well, actually, here's the one thing we do know, and history is always proven. If you buy and hold and you buy and forget about it, you're always going to make money eventually.
Yeah. And that's it. In a normal cycle, and people say to me, "Oh, when's the best time to buy?" I say 20 years ago. Second best time to buy is today.
There we go. Boom. Awesome. Harry, lots of flipping gold dust in there about property. Anything that you'd like to say? We're coming up to 40 minutes now. Anything that you'd like to say to wrap up to any would-be potential property investors in the audience?
Yeah, it's basically ignore the news, ignore the recession. Especially the people doing property investing, your local market and become best friends with the estate agent, because they will be the first signs of a true recession. Because I've got my relationship with this estate agent team for about 20 odd years. During lockdown, when prices went up, they were ignoring my phone calls, ignoring my emails because they had so many buyers. Now they're phoning me up because the market's slowing, it's taking longer for them to offload properties. So that is and they will be 3 to 6 months ahead of anything that the editors print in the newspaper. So people that are on the ground, paving the pavement, they know what's going on. So be best friends with your estate agent. Once they start phoning you, giving you deals, the market is slowing, it's reversing from a seller's market to a buyer's market.
Virtually like every other asset then, by the sounds of it. There's that saying on Wall Street, when your taxi driver starts asking you about an investment, it's probably time to sell if you're in that investment. You know what I mean? Because what that means is that word is disseminated throughout the public that this is a particular hot area. But if you think about it, right, there's only so much money that can flow into something until basically it runs out, and then that upward pressure of buying no longer continues and something collapses under its own weight. And property is no different. The one thing about property though is that it's obviously not as liquid, isn't it? You know what I mean? Whereas with shares, it's like bang, volatile, up and down every single day. But as I say, that still the thing that I just said just now still holds true as it does, of course, across any asset. Guys, anybody who's listening to this wants to reach out to Harry, feel free to reach out to him. He's on the Dentistry Invest Group, Harry Singh, also off Dental Property Club. I beg your pardon, Harry. Harry, you've been super generous with your time today. Thanks so much.
No, really enjoyed it. Time goes quick, doesn't it?
Time certainly does fly, my friend. We'll catch up soon. A little sooner this time than last time, given that was like a year ago. We'll speak soon, my friend.
Right. Thanks a lot, James. Take care.